Good day. Thank you for joining me. I'm Ryan Kudden. I'm going to be taking you through Caterpillar's full year 2018 results. The company has increased dividends for the past 25 consecutive years and it trades at a dividend yield of 2.8%. Dividend growth is expected to range in the high single digits in each of the following next 4 years, while management has indicated it will continue share buybacks as it still is creating value at this stage. The group has increased sales, which has significantly aided the operating margin, growing it to 16.7%. Additional margin expansion of between 300 and 600 basis points is expected through the cycle, and it will be driven by incremental service sales. Service revenue is in line with targets as it is expected to grow from $16 billion in 2016 to $28 billion by 2026. The driving force behind service revenue is piece part sales and digitally enabled solutions such as connected machines. This would provide less cyclicality to the business and smooth out profitability throughout different cycles, with service sales expected to be back-end loaded. While the US-China trade war remains a headwind for the business, as 28% of revenue is obtained from the Asia-Pacific region, it could be negated by the proposed US infrastructure bill, as an agreed $2 trillion would be committed by the US government to upgrading the country's aging infrastructure. US oil and gas is gaining momentum, and North American construction continues to grow. These should provide more demand opportunities in the future, which should aid margin expansion. Caterpillar is a good quality company with sufficient cash flow to keep balance sheet risk low. Cash conversion is not optimal, although this decrease is attributable to the increase in working capital resulting from volume growth in the current year. Earnings are beginning to gather momentum, with Q1 indicating management forecasts should be met. Current financial metrics are tracking in line with management guidance. ROE is positive, and additional shareholder wealth is being created, as evidenced by the ROIC over WACC ratio of 1.11 times. We therefore recommend an overweight position relative to the Dow Jones Global Titans 50 Index. Looking at a few financial highlights. Revenue increased by 20% to $54.7 billion. This was primarily due to higher sales driven by demand across all three primary segments. The increase in dealer inventories was driven by dealers' expectations of demand, which considers seasonal changes, macroeconomic conditions, and machine rental rates. Adjusted operating profit increased by 60% to $8.9 billion, and the operating margin showed substantial improvement, rising by 4 percentage points to 16.4%, driven by higher sales volumes. Manufacturing costs were higher due to a rise in steel prices and freight costs, while SG&A costs were high due to strategic growth initiatives. Adjusted earnings per share, excluding the effect of restructuring and tax costs, rose by 63% to 1,122 cents per share. Caterpillar paid a dividend of 336 cents per share in the current year, up 8% from 311 cents in the prior period. Looking at the cash flow. Cash flow from operations grew by 15% to $6.6 billion. Caterpillar has had a mediocre cash conversion ratio, which was negatively influenced by an increase in working capital expense in the current year. This increase supported the higher production volumes. Free cash flow increased by 10% to $5.2 billion and was more than sufficient to cover dividend payments and share repurchases during the period. We do not anticipate cash flow and dividend payments to be an issue in the future. Onto the balance sheet. Total assets grew by 2% to $78.5 billion in the current period, while total debt increased by 7% to $30 billion. The increase in debt was related to the financial product segment, which was primarily due to the rise in portfolio funding requirements. Caterpillar has sufficient cash flow to cover debt obligations. We feel the balance sheet risk is under control, with the EBITDA coverage being sufficient. The debt-to-equity ratio of the ME&T division increased by 7.5%. Looking at prospects. While there is a risk to the growth outlook, management specifically guided that they actually see more demand opportunities than negatives at the moment. Management expects 2019 profits to increase in the range of $12 to $13 per share. This was driven by modest sales increases and favorable price realization, while higher costs are expected to detract from these increases. However, the through-the-cycle margin range is expected to be between 10 and 21%. CapEx is anticipated to be between 1.3 billion and 1.5 billion, while operating margins are expected to improve by 3% to 6%, and dividend increases over the next 4 years will be in the high single-digit range. Free cash flow is expected to increase between 1 billion and 2 billion US dollars. If you would like to place a trade, please speak to a financial advisor or contact the trading desk. A comprehensive company analysis report on CAT can be found on PSG Online's trading platform. Before we end off, please take note of the following disclaimer. Thank you.